Welcome back to Smart Stock Sam, where we break down the numbers that actually matter. I'm Sam, and today we're diving deep into NIO's remarkable transformation and exploring what's actually driving this EV giant's momentum in 2026. We'll uncover the upcoming catalysts that Wall Street is buzzing about and answer the critical question: is this the real deal or just another temporary bounce? By the end of this video, you'll understand exactly what's next for NIO and whether their strategy has genuine staying power or not. Let's get into it. To understand how NIO pulled off this dramatic reversal, we need to examine the four fundamental pillars supporting their new trajectory. These aren't just incremental improvements. They represent a complete strategic overhaul that legacy automakers would struggle to replicate. For the first time in the company's history, NIO is projecting a Q4 operating profit of $165 million. They've scaled gross margins to 20% while simultaneously deploying 1,000 new battery swapping stations in just 12 months. But here's what most analysts are missing. NIO has evolved beyond being just an automaker. They've even cracked the top 30 globally in sustainability rankings. The question is, how do you engineer a turnaround from billions in losses to millions in profit in such a short time frame? The numbers tell a remarkable story. We're looking at a swing from a $756 million loss to a projected $165 million profit. This wasn't accidental. Record revenue hit $4.88 billion, driven by disciplined operational efficiency gains of 4 to 6% every single quarter. They've finally achieved what every growth company chases: true operating leverage. The math works now in a way it simply didn't a year ago, and Wall Street is starting to pay attention. Morgan Stanley recently issued an overweight rating with a $7 price target, primarily driven by the staggering 96.1% year-over-year surge in vehicle deliveries. That margin expansion you're seeing, it's the clearest signal that NIO is transitioning from a cash-dependent startup to a self-sustaining automotive powerhouse. But while these growth metrics are impressive, there's one asset that creates a genuine competitive moat, and most investors are completely overlooking it. NIO is currently opening 2.7 battery swapping stations every single day. Let that sink in for a moment. Nearly 3 new stations daily across their network. By adopting what they call a manufacturing mindset with prefabricated, factory-built modular units, they can activate a new site almost instantly. Traditional construction might take weeks or months. NIO does it in days. This isn't organic growth. It's blitz scaling at a level competitors simply cannot match without burning massive amounts of capital up front. Could Tesla replicate this infrastructure in under 3 years? Could BYD? The capital requirements alone make it highly unlikely. This is NIO's true competitive advantage, and it's being built in real time. But infrastructure alone means nothing without reliability. As of February 2026, NIO has completed over 100 million battery swaps. While the typical EV owner waits 45 minutes at a fast charger, NIO users are back on the road in 3 to 5 minutes. Their strategic partnership with Sinopec has allowed them to convert retired gas stations into instant EV energy hubs. The operational efficiency here is stunning. Yet there's a revenue stream hidden within this network that analysts are just beginning to understand. Here's the game changer most people miss. NIO isn't just an automaker, they're now a distributed utility company. With 3,700 stations, they function as a decentralized power plant. They purchase electricity during off-peak hours when it's cheap and sell it back to the grid during peak demand through peak shaving and frequency regulation. Even more remarkable, competing automakers are now paying NIO for access to their Swap Alliance network. This creates a recurring revenue stream that has nothing to do with vehicle sales. Think about the implications of that business model. Of course, none of this infrastructure matters if the vehicles don't resonate with consumers. This is where NIO's dual-pronged product strategy becomes absolutely critical. On one end, you have the ES9 flagship, high-margin luxury positioning that serves as the brand halo, driving aspirational value and premium pricing power. On the other end, the Onvio L60 has seen its user base quadruple to 132,000 units, targeting the mass market with competitive pricing and practical features. It's the perfect strategic balance. Premium profit margins from the ES9 fund continued innovation, while volume-driven market share from ONVO establishes scale and network effects. The real question investors should be asking is whether they can maintain this delicate balance as they scale production. Because if one side falters, the entire strategy could unravel. And their ambitions aren't confined to China. NIO is making a calculated entry into North America through Canada. By leveraging local manufacturing policies, they're effectively bypassing traditional trade barriers and establishing a global export hub. That 96% delivery surge isn't just a China story. It's the opening chapter of international expansion. Whether they can navigate geopolitical headwinds remains to be seen. Sustainability isn't just a marketing buzzword for NIO, it's becoming a genuine competitive advantage. Their number 30 global ranking in sustainability is attracting ESG-focused institutional capital at an accelerating pace. In 2026, green credentials are no longer optional for automakers. They're the price of admission to attract large-scale investment. NIO understands this shift better than most of their competitors. The ultimate stress test for any network is how it performs during a crisis. The upcoming Spring Festival on February 17th represents exactly that kind of test. This is the world's largest human migration, and NIO is preparing with 1,009 highway stations, 350 service centers remaining operational, and 10,000 industrial battery packs pre-positioned to ensure zero service disruptions. If they execute flawlessly, it cements user trust. If they stumble, it damages their reputation significantly. NIO is using this event strategically to drive brand loyalty even deeper. For the Spring Festival period, the ONVO brand is waiving all battery swap fees entirely. Need extended range for a road trip? You can rent a 150 kilowatt-hour battery pack by the day and return it when you're done. This kind of user-centric flexibility is precisely why their customer retention rates are hitting all-time highs. Traditional automakers simply cannot offer this level of service adaptability. So, what does all this actually mean for investors? Let me be clear about something important before we wrap up. Nothing in this video constitutes financial advice. I'm not a licensed financial advisor, and you should always conduct your own research and consult with a qualified professional before making any investment decisions. This analysis is purely educational and represents my perspective based on publicly available information. With that said, the evidence is compelling. NIO has successfully transitioned from cash burn to operating profitability. They've constructed a defensive moat through their swapping infrastructure and unlocked an entirely new business model that combines traditional vehicle sales with high-margin energy grid services. The question isn't whether smart EVs have a future. It's about which companies can scale fast enough to dominate the infrastructure that powers them. Right now, NIO is leading that race. We'll be tracking their Q4 earnings closely on the channel, so make sure you're subscribed and notifications are on. If you found this analysis valuable, smash that like button and drop a comment below with your thoughts on NIO's strategy. I'm Smart Stock Sam, and I'll see you in the next one.